Hi everyone. The Union Budget 2025 is days away from being announced, and all eyes are yet again set on the Honourable Finance Minister Nirmala Sitharaman and her volley of proposals and policy recommendations. The Indian economy is witnessing a very interesting and significant phase for the M&A transaction landscape, which is influenced by a multitude of global and macroeconomic factors. The global economic growth, the Western war disturbances, or the China Plus One strategy, all aimed at diversifying the investment and business concentration risk away and evaluating other jurisdictions. To this end, the government's thrust to introduce policies, including tax reforms, that are conducive to the overall investment regime and ease of doing business are truly noteworthy. Having said that, some of the areas wherein further nationalization may be considered by the government in the upcoming budget are as follows. In terms of policy reforms, the unambiguous interpretation and application of bilateral conventions is a must-have. Two significant events that merit a discussion are the amendment to the India-Mauritius Tax Treaty Protocol introduced in March of 2024. The protocol was introduced with the aim to adopt the BEPS-related anti-abuse provisions by amending the preamble of the DTA and introduction of the PPT test. While the protocol said that it would be applicable from the latter of the two dates when the countries to it adopt the same, however, the language also suggested that the revenue authorities may apply the same retrospectively, covering past investment in structures. The MFN controversy, wherein the Apex Court in a landmark ruling held that for application of existing MFN clauses in tax treaties or protocols, a notification in the domestic tax laws is a must. Following this, and in a retaliatory measure, the Swiss Competent Authority also withdrew the Switzerland's unilateral application of MFN with effect from 1st of January 25. In order to sustain and provide an impetus to the foreign investment in the country and address tax cost burden on the participating entities, the government should take appropriate measures to address such ambiguities. The income tax laws provide for a concessional tax rate of 15% for new domestic manufacturing entities. This beneficial rate is available for companies which have started manufacturing and production operations by March of 31st, 2024. In order to boost the foreign investment into the country, especially for new entrants, the sunset period may be extended by a couple of years. Furthermore, the regime may be extended to specific service sector entities with ancillary conditions. The buyback tax. Finance Act 2024 has significantly amended the buyback tax rules. Any buyback initiated on or after 1st of October 2024 is now governed by the new provisions. Essentially speaking, the buyback proceeds are now taxed as dividend income in the hands of shareholders, and the cost of investment or acquisition is now treated as a capital loss available for adjustment as per the provisions of IT Act. There could be situations pertinently with foreign investors wherein the sole investment in India are bought back, leading to a double whammy in the form of upfront tax cost on account of the dividend taxation and the cost of investment becoming a sunk loss. The government may hence evaluate the situation from the investor's perspective and may make suitable amendments so as to spare the cost of investment from the tax ambit. Taxation of unlisted debentures. The Finance Act 24 had brought unlisted debentures and bonds within the ambit of Section 50AA of the Income Tax Act. Simply put, on and from 23rd of July 2024, any gains on account of transfer, redemption or maturity, irrespective of the holding period, would be taxed as short-term capital gains at applicable slab rates. Now, debt investments serve as a significant source of funding, especially in cases of startups and new entities where valuations are not significant and investors are averse to commit equity funding. The amendments may hence be revisited and taxability of unlisted debt instruments may be brought in line with the other class of assets. Additionally, and as an important policy measure, the government may consider bringing back the beneficial withholding tax provisions like 194 LC and LD in case of the interest on debt raised by Indian entities from overseas sources. The cross-border M&A rules introduced by the MCA and RBI. The Ministry of Corporate Affairs had introduced the cross-border M&A rules back in April 2017, covering schemes being undertaken under the NCLT regime. The notification required prior RBI approval requirements for the same. Following the same, the RBI in a notification in 2018 had provided a deemed approval to the inbound and outbound merger transactions involving Indian companies. It is pertinent to note that the notification made reference to a scheme being undertaken under the NCLT route. Very recently, last year in September, The AMC had also amended the cross-border rules once again to cater to a specific situation involving consolidation of a foreign transferor company with its wholly owned Indian entity under the fast track or a central government approval merger route. The sub-rules that were introduced last year created a requirement for both the companies to seek a prior approval from RBI. The RBI's 2018 notification provides for a deemed approval to cross-border transactions, and the same is applicable for NCLT-driven schemes. It would hence be helpful if necessary clarification is issued extending the benefit of deemed approval to the schemes implemented under the central government route as well.